Welcome to our video today where I tell you how to make money in the stock market no matter what it is doing. This is a trick that hedge funds use to make money that many people don't know about. This trick is called pairs trading. First, what I'm going to do is I'm going to explain the trick. Then I'm going to go and do an example of the trick to show you how to do it. My name is Jacob Braun. I'm the host of this weekly Monday night episode here on Best of Us Investors. I'm also a writer for Seeking Alpha and the founder of Braun Capital Research Firm. So, what is a pairs trade? This is a strategy used by hedge funds that is a little bit complicated, but I believe you guys will be able to quickly pick up on it. And what it is it's something called a market neutral bet. So the bet has nothing to do with how the market's performing. It just simply has to do with your bet specifically. Another name for it is called a statistical arbitrage. You see this used a lot by different funds on Wall Street, and it's even done automated a lot. So what we're going to do is we're going to make a bet, a pairs trade bet that is between security A and security B. And what we're going to do is we're not betting on how much a security will go up or how much a security will go down. That would be just a straight bull or straight bear case. You could do this through, buying a stock or shorting a stock or buying a call or selling a call, buying a put, selling a put. Right. That would be just doing a loan play on a company. What we're going to do is we're going to bet on the difference between company A and company B. So we're not betting on the single one. We're going to bet on the difference between the two companies. And when you perform this correctly, it's completely market neutral because you should do it between two companies that are very similar. For example, you should do two companies that are in the same sector. So then you don't have to worry about issues within that sector, and you don't have to worry about issues in the whole global economy. Because, for example, if COVID-19 happens, that doesn't affect just one stock. That affects the whole market. So both company A and B would be affected by it and react similarly. Additionally, when we go into the example later, we'll talk about this. But if you have something with two companies that are very similar in the same sector, then they'll react similarly when something happens to that sector. Okay, so how do we do a pairs trade? I've talked kind of like the big concept here, but how do we do it specifically? Well, how we're going to do it specifically is we're going to go long one stock and we're going to go short another stock. So going along a stock is when you bet on the stock going up, and going short on a stock is when you bet on the stock going down. And the key to this investment is that the company that we think is going to perform better. So if we have a gap between two companies, if we think company A, which is above, is worth more than company B, and we think that gap is going to increase, we would go long company A and short company B. So that means that we believe company A is going to pull further away. Now, if the reverse is true, so let's say you think company A, which is the company that's worth more currently, is going to do worse in the long term than company B, then we would go short company A and would go long company B. So I'm going to explain this a little bit more, but basically we're betting on which way we think the gap between the two companies is going to go. For just quick definitions, long is buying the company. So for our example, we're going to say we're going to buy 100 shares of that company. Going short, it's selling 100 shares of that company. Well, you might be thinking, how do I sell shares of a company if I don't have any shares of a company? Well, to do this strategy, you'll probably need a margin account, which allows you to basically borrow shares from other investors and then sell them on the market. And how that works is what you do is you buy shares, or you borrow shares, and you're going to pay a small fee to borrow those shares to your brokerage, and you sell them. And the goal is that you're going to buy them back later. If you're a naked short, not naked short, just a regular short, the goal is that let's say you take these shares, you sell them at $100 each. And then you hope the stock falls to, for example, 80, where you're going to buy them back and then give them back to the people you lended them to. And so you make that $20 per share profit between where you sold at 100 and you bought it at 80. So it's like a reverse bet of when you buy a share, because when you buy a share, you want to, for example, buy at 80 and then sell at 100. So again, that requires a little bit of a new account, usually a margin account. You can look into, for example, just Google your brokerage and just say, shorting TD Ameritrade or something, and you can find the information on how to get that done on your account. So again, what we're going to do is we're going to go long one stock, short another stock. And what that does is it allows us to make a bet not on that company independent of any other variable, but that company compared to another company. And because of this, if you pick two companies in the same sector that are similarly sized, for example, we don't want to pick a big company and a small company, because some things will affect small companies way more than big companies. For example, a new tax bill or regulation that's more global, because some usually bigger companies are more across the globe. So we want to pick a company that's a similar size in a similar sector, and then we want to make a bet between the two companies. And when we do this, we created a market neutral bet. So our bet does not matter how the market's going. Our bet won't be affected. Our bet, our thesis behind our investment, behind our bet, is all that matters, because anything that affects that whole market is going to affect our bet. So I'm going to go and do an example. I'm going to share my screen, and so to show you these companies. Right here we have, I'm real quick, I'm going to show you my Twitter. If you want to stay up to date on the different things I do, check me out at Real Jacob Braun. Additionally, we're going to be using stockcard.io to look at these different companies. Stockcard.io is a great tool that uses AI to tell you about companies. They're the sponsor of this video, and I would highly recommend checking them out. If you end up subscribing to them, please use the code BESTOFUS to let them know we sent you. So the first company, what we're going to do is we're going to choose Chevron Corporation, and then we're going to choose ExxonMobil. Both of these companies are big companies, and they're primarily US based, but they also have global operations, and they're in the same sector. They're in the oil and gas industry. So they're very similar companies. And what we're going to do is we're going to make a bet between these companies. For example, over the past 1 year, Chevron is up 57%, which is a great deal to the rising oil prices. Over that same 1 year, then we have ExxonMobil up 47%. So if Chevron's up 57%, ExxonMobil's up 47%, what does that represent? Well, Chevron's up 10% over ExxonMobil. So if we made this bet and we went long Chevron, so we bet for Chevron and went against Exxon, and we shorted Exxon a year ago, then we would have resulted in a 10% gain before any fees if we sold out at this 1 year mark. Now, if we had done the reverse, if we'd been wrong in our thesis and gone long Exxon and short Chevron, we'd be down 10%. So that's kind of how this works. And what's great about this is, for example, the oil and gas industry, it got killed by COVID-19 because of the lack of travel. So if you had made this bet between these two companies, well, that killing, because of COVID-19, that hurt the whole market, but especially the oil and gas industry, wouldn't have had really effect on your bet, because both those companies would have been hit the same way. And because they're like a global thing that hurts the whole market, will affect them. As something that's sector specifically, for example, the Russia-Ukraine war, while it's really hurting most of the market, it's really boosting the oil and gas sector because of the sanctions on Russia. And so this bet is going way up on both of these companies, which you probably want to capitalize on. But again, it can go in the reverse way if the whole sector is way down. And so that doesn't affect the bet. The only thing that affects the bet is the performance between the two companies, whether that gap between them expands or shrinks. So if we look at this, this is a very common example because, again, two big corporations that are in the same sector, and we can see how that would have performed. Now, for you specifically, if you're going to make this bet, you want to be very smart about your research on it. Do not make this bet in a very volatile field. Because when you're short a company, you have unlimited downside. Because in theory, right, if you, let's say you buy shares of a company, what's your upside? Well, it's unlimited because the shares could, in theory, go to any price. What's your downside? Well, your downside is only the price you paid for the company. In the reverse sense, when you short a company, your upside is only the price you pay for that company because it can only go from that price down to zero. And your downside is actually unlimited because the stock could theoretically go to any price. In practice, is it really going to happen? No. But that's something to be aware of. The company could explode, one of the companies, and you could have a huge loss. So that's why you do not do this in a volatile sector. For example, this would not be a great investment in a cryptocurrency, especially a small cap cryptocurrency, because those are very volatile and swing on random things. So if that happens and you're short on those, your trade's busted, and that's just not using this trade properly. Another example of it, something you do not want to perform this trade in, would be in the biotech sector, and specifically the early stage biotech sector. For example, one of my favorite companies, Cassava Sciences. I love the company, but I am not performing this trade with them because it has massive swings up or down, and I do not want to have to deal with those massive swings because I want my thesis to be based around just a slow gain or rise between the two companies and the gap shrinking or closing. When you perform this, you perform it on big companies that are pretty stable and are very similar. So you do not want to pick volatile industries, and you want to pair similar companies. Could you make this trade between, for example, Google and ExxonMobil? Yes, you could. But would that be a smart trade? No, it wouldn't, because that's just basically naked bets between the two. There's no similarity between the two companies or where they are, other than them both being US companies and both being big. So you want to be the key to this is picking similar companies, because then what you're doing is you're reducing all the outsized noise and only dealing with the performance between the two companies. Another example where this is commonly performed is when one company is priced higher than a very similar company for some random reason. For example, if a company is just included into the S&P 500 or the Russell 3000, one of those big passive index funds, many people will buy a bunch of that stock in anticipation of an increase in share price for its inclusion. Well, what that does is it throws off the balance between buyers and sellers, and it leads to the company temporarily being maybe a little mispriced. This trade, if you pair that with a similar company, can catch that mispricing from that imbalance of buyers and sellers, and you could potentially make a very good investment from this. So again, the real reason you do this investment is because it's market neutral. You're not going to be able to make as much money, most likely, as if you just do like a single bet on a company, or like a straight call or straight short on a company. But the benefit between this is if the whole market tanks 20 or 30%, then you don't have to worry about that because your whole bet will go down with it. And again, you're only betting on the gap between the two companies, not the market as a whole. So that's really why I like this bet. And I think it's a great bet and strategy to have in your toolbox. If you have any more questions, you want to talk about this further, reach out to me on Twitter at @RealJacobBraun. I love to talk to you guys and love for different video ideas. With that being said, thank you for watching this episode, and I hope you have a great day.